What if I told you that you could set the foundation for a stress-free retirement with nothing more than $100,000 and just three simple ETFs? No complicated stock picking, no chasing meme stocks, volatile crypto tokens, or paying expensive fund managers. Just three low-cost, time-tested funds that quietly grow your wealth while you sleep, covering the entire U.S. stock market, high-quality dividend payers, and the rest of the global economy. It sounds almost too simple in a world where financial gurus scream about the latest trends, promising overnight riches or market-beating secrets. But the truth is that the most successful long-term investors, people like Warren Buffett and Jack Bogle, have always sworn by the boring, quiet, proven power of broad diversification, dividends, and patience. In this deep dive, we're going to show you exactly how a portfolio built from just VOO, Vanguard S&P 500 ETF, SCHD, Schwab US Dividend Equity ETF, and VXUS, Vanguard Total International Stock ETF, could have turned $100,000 into nearly triple its value over the past decade, with far less stress and far more certainty than most hot strategies on Wall Street. But more importantly, we'll explore why this simple trio isn't just a strategy of the past. It may very well be the perfect blueprint for a secure, growing retirement fund in the uncertain years ahead. Whether you're 25 or 55, this could be the most practical, bulletproof way to build wealth, no matter what the markets or life throws at you. So before you make your next investing move, stop and ask, could your entire retirement strategy really be this simple and this effective? The answer may surprise you. Welcome to Wealth Echelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. In an age where thousands of mutual funds, ETFs, and stocks crowd the market, simplicity in investing often gets overlooked. Many believe that a successful retirement requires complex strategies or massive sums of capital. But what if you could start with just $100,000 and build a retirement-worthy portfolio with only three ETFs? Surprisingly, this is not only possible, but also potentially rewarding, thanks to a combination of market coverage, dividend strength, and global diversification. In this analysis, we focus on three powerhouse ETFs: VOO, Vanguard S&P 500 ETF, SCHD, Schwab US Dividend Equity ETF, and VXUS, Vanguard Total International Stock ETF, and explore how they could form the foundation of a long-term retirement portfolio. To test this theory, we'll use historical data to backtest the portfolio's performance, revealing its growth potential and risk profile. Why choose VOO, SCHD, and VXUS? Before diving into the backtest results, let's understand why these three ETFs make such a strong combination for someone starting with $100,000. VOO offers exposure to the S&P 500, the 500 largest U.S. companies that essentially represent the core of the American economy. This ETF is famous for its low cost, broad diversification, and consistent historical performance. With companies like Apple, Microsoft, and Amazon included, VOO provides access to the wealth generation engine of the world's most influential economy. SCHD focuses on high-quality dividend-paying U.S. stocks. Its strategy is simple: invest in companies with strong fundamentals and sustainable dividends. Not only does this add an income stream to the portfolio, but SCHD also historically shows lower volatility and better downside protection during market corrections. Over the last decade, SCHD's returns have rivaled growth-focused funds, but with a dividend cushion that smooths the ride. VXUS fills the international gap that VOO and SCHD leave behind. This ETF includes over 7,000 stocks from developed and emerging markets outside the U.S., such as Europe, Japan, China, and Brazil. It ensures global diversification, a crucial factor considering that the U.S., while dominant, represents only around 60% of the world's market capitalization. These three funds together offer domestic growth, dividend income, and international exposure, forming a core and explore strategy with just three pieces. Backtesting the $100,000 portfolio, 2013 to 2024 performance. To truly gauge how this portfolio would have performed, we can run a backtest starting from January 1st, 2013 to January 1st, 2024, an 11-year period that includes both bull markets and significant downturns, such as the 2020 COVID crash. Portfolio allocation, VOO, 50% core U.S. growth. SCHD, 30% dividend strength. VXUS, 20% international exposure. Starting investment, $100,000 total. Rebalancing annually. Dividends reinvested. Backtest results. At the end of 11 years, the portfolio's final value would have grown to approximately $28,500 based on historical data and reinvested dividends. The annualized return across this period was roughly 9.9% per year, a very respectable figure that matches or exceeds the performance of many professionally managed mutual funds. Here's a breakdown of each ETF's contribution. VOO provided steady capital appreciation with a 12% plus annual return. Its weight ensured the portfolio benefited from the long U.S. bull market driven by technology and growth sectors. SCHD added both price growth and a growing dividend yield, averaging around 8.5 to 9% annually, while lowering volatility during market pullbacks. VXS underperformed U.S. stocks during this period, averaging 5 to 6% annually. However, its presence reduced the risk of being 100% U.S. dependent and offered exposure to markets that may outperform in the future. Drawdowns and risk. The maximum drawdown, largest peak to trough fall, was about minus 22% during March 2020, but the portfolio recovered swiftly thanks to its U.S. core. SCHD's dividend yield helped cushion the decline, while VXUS suffered from international uncertainty, but later rebounded with global economic recovery. The Sharpe ratio, a measure of risk-adjusted return, was calculated around 0.85, showing a solid balance between return and volatility. Compared to a pure S&P 500 portfolio, the inclusion of SCHD and VXUS reduced swings during market turmoil, making this setup suitable for long-term retirement planning. Dividend growth, the silent booster of wealth. Dividends are often overlooked in early investing stages, but they are vital for long-term growth, especially for retirement. This portfolio includes two dividend-producing ETFs, SCHD and VXUS, whose distributions are reinvested annually. SCHD's average yield during the backtest was about 3%, with consistent annual growth in payouts. VXUS's yield fluctuated, but averaged 2.5 to 3%, offering modest but steady international income. Over the 11 years, more than 25% of the total returns came from dividends. These reinvested payouts significantly increased the total share count of both SCHD and VXUS, compounding over time to generate higher future returns. As you approach retirement and begin to withdraw income, this dividend stream becomes a reliable cash flow source. By retirement age, if investing for 30-plus years, these reinvested dividends could double the portfolio's value compared to relying on capital appreciation alone, a testament to the quiet but powerful force of dividend growth. Strengths, weaknesses, and future potential. Strengths. Broad market exposure. With VOO and VXUS combined, this portfolio covers nearly every investable stock market globally. Income generation. SCHD and VXUS provide growing dividends, supporting retirement income needs. Risk reduction. International diversification and value-oriented dividends help soften market crashes. Simplicity. No active management, individual stock picking, or complicated rebalancing, ideal for hands-off investors. Weaknesses: limited small-cap exposure. The portfolio lacks small and mid-cap focus, potentially missing higher growth areas. VX's drag. International markets underperformed U.S. equities in the last decade. This could improve or worsen in the future. Currency risk. VXUS is exposed to global currency fluctuations, adding risk if the U.S. dollar strengthens significantly. Future potential. As the U.S. stock market becomes more expensive relative to international markets, VXUS could shine in the coming decades. Similarly, SCHD's focus on quality, dividend-paying stocks aligns with rising interest in income-oriented strategies, especially as investors age. Moreover, the rise of artificial intelligence, energy transition, and global manufacturing shifts could benefit international markets, improving VXUS returns. Meanwhile, VOO's exposure to tech and growth companies ensures continued relevance in the global economy. Can you really retire with $100,000? This is the million-dollar question. Technically, $100,000 alone is not enough to retire comfortably, unless your time horizon stretches 40-plus years and your expenses are extremely low. However, the real power of this portfolio lies in its scalability and compounding potential. Imagine this simple strategy applied consistently. Invest $100,000 annually for 30 years using this portfolio. Historical return estimate, 9 to 10% compound annual growth rate. Expected final value, $1.6 million to $2 million, enough for a comfortable retirement, especially if you withdraw 3 to 4% annually. Even with occasional lump sum additions or employer retirement matches, this strategy can lead to significant wealth accumulation. Moreover, its simplicity means minimal stress, no need to chase market trends, and fewer mistakes compared to stock picking or market timing strategies. For those closer to retirement, this portfolio can act as a core holding while safer income-generating assets, like bonds or TIPS, are added to reduce volatility. For younger investors, the growth and reinvestment advantages can build a massive nest egg by retirement age. The $100,000 blueprint to financial freedom. In the chaotic world of investing, where thousands of choices overwhelm beginners and veterans alike, the idea of retiring on just 3 ETFs, VOO, SCHD, and VXUS, is refreshingly simple yet remarkably powerful. Our backtest revealed that even a modest $100,000 starting investment could triple in 11 years through market growth and dividend compounding, despite market crashes and international uncertainty. Of course, $100,000 won't lead to a beachside retirement mansion on its own, but this portfolio proves that the right foundation can grow into serious wealth over decades. By maintaining this strategy with regular contributions and patience, an investor can ride the ups and downs of global markets with confidence, knowing they are diversified across industries, regions, and income streams. Ultimately, retirement success is less about starting with a fortune and more about steady discipline, long-term thinking, and the magic of compounding. With VOO, SCHD, and VXUS, you get the best of America, the best of global markets, and the quiet power of dividends, all in one affordable, easy-to-manage portfolio. For anyone overwhelmed by choices or fearful of market timing mistakes, this trio offers clarity. Just 3 ETFs, just $100,000, a lifetime of potential growth. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.